Hello, welcome from DBS Asia Central at the Spark Studio on the third floor of DBS offices. I'm Tamir Bek, Chief Economist. Welcome you to our August Livestream for macro insights and some other insights in the world of geopolitics as well. With me, Senior Rate Strategist Eugene Leow. Hi, Eugene.
Hi, good afternoon.
It's been quite the month.
It has been many things to unpack.
Lots to unpack, but of course we cannot unpack everything. So we will focus on tariffs, stablecoins, and I was just joking with Eugene before this session began. We should also have mentioned rates part. There's a lot going on the U.S. fiscal side, inflation expectation side, Fed policy, Fed leadership, Trump's fingerprints everywhere, and of course what's happening with the sort of global sentiment with respect to U.S. curves, and also not just the U.S. curve. Eugene, we'll talk a little bit about the other
Asia
rates as well. Yes. So all of that will be covered in the next hour or so. As you know, this is a live stream, but it also has a Q&A segment. For that, we will offer you the QR code on the screen right now. And if you're not going to be scanning the QR code, you can most certainly do the usual thing, which is go to dbs.pigeonhole.at, enter passcode macro August 25, or rather AUG25, AUG25. That'll also take you to Pigeonhole. Send your questions or upvote the questions that are already there. We'll be happy to take them as and when time permits. So Eugene, let me start with the tariff and stablecoin part, and then hopefully will not take more than 20-25 minutes, and then it's yours.
All right.
Very good.
All right.
Sure. So let's start taking stock. The tariff picture, pretty adverse. The U.S. has not seen average tariff like this in a generation or two or even three. In fact, if you look at it, I mean, basically the 1940s was the last time U.S. had such exceptionally high tariffs. We have entered into basically uncharted territory in living memory. But more importantly, this is not the end of the tariff story. I can assure you that no nation out there or no sector out there is resting easy right now just because in the last 3-4 weeks we have seen a few letters here and commitments there and quote-unquote agreements between the U.S. and other countries. Many countries went to Washington, D.C. with their representatives, had discussions with the U.S. Treasury, with the Trade Representative's Office, felt they had the contours of certain agreements of how much they want to buy from the U.S., what would be the tariff relief, and so on. And on their flight back to their respective countries, were surprised by a tweet or a truth by Donald Trump, which suggested a very different set of outcomes out of that. So I think that's been a very chastening impact. I mean, what I'm talking about is not abstract at all. I can cite at least 2 countries where things like this happened, where the authorities came back from Washington, D.C. and were blindsided by very different terms of the quote-unquote agreements. What that tells you is going forward, depending upon global developments, macroeconomic situation, the U.S., by that I really mean Donald Trump, can change its mind on any of these tariffs. These are all executive decisions. They don't require congressional approval. There are some court-related complications. There are some challenges to the legality of some of these things, but you can be sure that Donald Trump and his team will fight tooth and nail to make sure that their leverage and their ability to impose exorbitant tariff and take them up or bring them down as part of various negotiations will remain, and as long as Trump is around and perhaps even beyond that. This is a sea change in the way companies and countries will do business with the U.S. going forward. There will always remain this uncertainty. You cannot plan for 2 years, 3 years business environment with a fixed point as far as tariffs are concerned. They may be higher, they may be lower, you will not know. We're also seeing that beyond that original rationale, the theme that Trump has pursued through his first term, as well as leading into this 2024-2025 election season, was that the trade imbalances are intolerable, other countries are impoverishing the U.S. needs to put up tariff to improve the balances. That story is there, but it has been supplemented by many, many other rationales and many, many other weaponization aspects of tariff. What we've seen right now is that whether it is a Russia-Ukraine conflict or the India-Pakistan conflict that happened a few months ago, the U.S. has inserted itself into these things with using tariff as a stick to force the various antagonistic parties to come to the table. Similarly, if you think about what's happening between the U.S. and India right now, that U.S. wants to squeeze Russia, and to squeeze Russia, it is insisting that India stop buying oil from Russia, and if India is being recalcitrant with respect to that, they are going to put another 25% tariff on Indian exports to the U.S. Again, things that were sort of unthinkable from the Indian camp even like 4 weeks ago are now very much a plausibility. I personally think the next time we come back to you for the Macro Insights live stream, that 25% will go away. Between Putin and Trump summit that's coming up and various other negotiations that are happening between the Indians and the Americans, that'll go away. But it still underscores the point that now we have a wider way the U.S. is approaching the tariff situation. They use the leverage from tariff on various other factors. And just a few days ago, we heard that both NVIDIA and NVIDIA and AMD, they will now resume selling high-end chips, well, with some restrictions on the tech side, but fairly advanced chips to China. But whatever they get as revenue, 15% of that would be surrendered to the U.S. authorities. So that is an export tax, very new dimension to the entire tariff story. All this time it was an import tax, importing stuff. Now if you're selling somewhere and I can sort of insert myself into that discussion, I can get a cut from that too. We will see how all of these various methods of weaponization net into. I'll tell you a couple of things that are very clear to me. Number one, the U.S. is going through a substantial increase in sales tax related to imports, sales tax related to exports. That is very, very clear. And that will in some ways offset the stimulatory impact of the big beautiful bill, which of course extended some of the Trump 1.0 era tax cuts, as well as provided additional incentives in the Social Security side, as well as on the capital side. So the U.S. fiscal path itself is going to be complicated by some of these things, and I'll talk about the fiscal path momentarily. Just want to make one final point. This is about the transshipment-related penalties. We heard that when the Vietnam-U.S. deal was announced, that 20% on Vietnamese exports to the U.S. and 40% if there's transshipment. Now, everybody's sort of scratching their heads as to saying who decides on what is transshipped, from where, and so on. I just spoke with somebody from Vietnam today, and they were telling me that Korean manufacturers in Vietnam are very worried because they bring a lot of inputs from Korea into Vietnam, and then they export to the U.S. If that is going to be subject to 40% tariff, it's just a complete game changer for those Korean manufacturers with respect to using Vietnam as a conduit to sell to the U.S. Now, you know very well this really is about China, but the language is so general that it is now applicable to everybody. And everybody is getting very worried about to what extent the U.S. Department of Commerce, Treasury, and other related departments will come after products that are deemed to have components that are transshipped. Now, how will they do it? My basic understanding, this will be a bit of an art, and it is giving so much leverage to the U.S. enforcement agencies right now. They're basically the judge and the jury. The counterparty nation or company will have very little recourse, and even if they do, it'll take a very protracted process to push back against the levy of either the 40% duty or some penalty, because they can even decide that the country or companies are transgressing. All of those things will again play out in the coming months and will be another source of A, uncertainty, B, higher cost of doing business. All right, now let's talk a little bit about the fiscal dimension that I just promised a little while ago. Tariffs are bringing in serious revenues to the U.S. I mean, it is pretty impressive. So if you can see the chart, and hopefully it's large enough and clear enough on the screen, that the U.S. in the first 6 months of this calendar year has raised revenues that are heading toward the $100 billion range. And that is substantially bigger, than almost 3x bigger than what was the case at this time a year ago. So the tariffs are bringing in a lot of revenues, but the U.S. fiscal picture is complicated by the fact that spending is going up a lot too. So let me show you the next chart. This is a chart that is coming from the U.S. Department of Treasury. It sort of reports on a daily basis how much the federal spending is. And this is showing federal spending is up about 7% on a year-on-year basis. And the difference between the black line and the gray-orange line on the screen is much bigger than the delta on the tariff side. So looking at this picture, you would think the tariffs are making a difference, but not sufficient difference because it is not offsetting the pickup in spending. Now, I have to caveat these slides with some nuances. The first one is that on a fiscal year basis, the US fiscal year starts in October of every year. October to June, the data that is coming out of the US Treasury is consistent with this analysis that I have, which is US revenues are doing well, but spending is growing even faster. And as a result, as you can see in the bullets on the right-hand side of the screen right now, the federal deficit is worse than it was at this time last year, about 100 billion more. Now, the reason I'm hastening to add some caveats to this whole analysis is that if you start thinking of the US only in calendar year terms, then the picture is a little better. And it's not because of tariffs, because the tariff picture, the spending picture is already provided on the screen. It's because of a third factor, which is non-tariff revenues, income tax, capital gains tax. They have also done pretty well so far this year. So I think the dust is yet to settle on the US fiscal picture and the contribution of tariffs, because there are other countervailing developments, spending side, non-tariff revenue side. But all in all, I think we need to sort of appreciate that when we talk about US spending envelope, we're talking about trillions of dollars. And when we're talking about tariff-related stuff, we're talking about billions. Okay, granted, almost $100 billion, but it is nothing close to the total spending envelope of the US, which is about 40 times bigger. Now, on the inflation side, to those of you who receive our publication probably a few hours ago saw in your inbox, we did a write-up on the overnight US inflation print, which we felt was a bit of a mixed bag. The market seemed to have been pretty satisfied with the data. They saw the headline number of 2.7% and core inflation number of 3% as 3.045% actually, as fairly conducive to expecting the Fed to go back into cutting mode from September onward. We don't really quarrel with market's interpretation of the data, but we would like to hastenly point out, and that is detailed in the note that we published a couple of hours ago, is that when you look at certain components of the US CPI, so secondhand cars or pre-owned cars, or what's happening in the services sector, there are some telltale signs of inflation picking up. Good side, so far so good. But so far so good is the operating word here. American companies are following a three-pronged strategy in dealing with tariff. They are squeezing the suppliers. That's the first thing you can do. If tariff goes up by 10% and your supplier gives you a 10% discount, well, you don't have to worry about anything else. Your life goes on perfectly the same. As far as you're concerned, you're paying the same, and the US Treasury gets 10% more, but you got a 10% discount, so you can sell the stuff with no loss of profit. But life is not that straightforward. We're not talking about 10% tariff. We're talking about 15, 20, and even higher for most countries of the world. And most goods exporters operate in very thin margin. So I don't think US importers will be driving their suppliers out of business by passing on the entire tariff to them. This is where I think Donald Trump gets it wrong. I think his implicit understanding is the US market is so irresistibly large that foreign sellers or foreign governments will subsidize themselves or discount themselves to the extent that the tariff goes to Treasury's pocket and the US consumers see no change in the retail prices. They're wrong about that because there's only so much you can squeeze your suppliers. There are then two other options. So option one, squeeze your supplier. Option two, take a hit on your balance sheet. You pay the tariff and you say, I make less money. And we've seen a bunch of US companies already beginning to give signals along the road. Third one, you pass on the price to your retail buyers. I think over the coming months and quarters, three will be protracted, but will be the key driver of inflation and pass-through after squeezing suppliers a bit, after taking some hit on their balance sheet, US producers will start passing it on. What you have on the screen right now is the Fed surveys coming out from New York, Kansas City, Philadelphia, and so on. And when they ask regional manufacturers what's happening with prices, well, they are basically saying that most of them are paying higher prices, and by the same magnitude as they were 3 years ago in the summer of 2022, when, mind you, inflation was as high as 9%. So things are not that hunky-dory in terms of producers and sellers in the pipeline price pressure. This will show up sooner or later. It's a matter of time. In a protracted manner, not like taking inflation to 5%, but it'll show up nonetheless, which will make the Fed's life difficult. They may get away with a couple of rate cuts this year. Next year, we'll have to see how things go. There are monetary aspects to this as well. If you see the second chart on this panel right now, The money growth has turned into positive territory. That also has an impact. We now see in the US economy massive wealth creation taking place because of the stock market boom. All of those things are also going to feed into expectation of wanting to buy more things, wanting to earn more, and that then feeds into higher inflation expectation and actual realization of inflation. So we got to think about tariff pass-through, but beyond that, we got to think about a bunch of other things. Immigration crackdown. Earlier, I think I said it very quickly, but let me repeat that. On the US inflation trend, goods side inflation is actually not that bad. It's the services side inflation that is beginning to pick up. And I can see why. Because in addition to the tariff narrative, there's also the immigration narrative. The US is cracking down on undocumented workers. They have not really actually deporting many more people now than they were taking place during the Biden years. But of course, their noise and fury is such that it's clearly creating a lot of panic and fear among undocumented workers. Now, what do undocumented workers do in the US? They work in the agriculture sector. They work in fisheries, or all those lobsters you eat from Maine. Who do you think is harvesting them? Most of them are undocumented workers. They're in hospitality industries, waiters and delivery people, and they're in the travel tourism industry as well. So they're a very large part of the US service sector that rely heavily on undocumented workers. And as the crackdown continues, there will be a supply crunch there of labor, and that could also push up costs of doing business. I've touched upon money growth and asset price issues as well. Let me touch on the final point, which of course is the whole drama that is happening between Trump and the Fed. He is being very, very tough and rather mean-spirited in talking about Jerome Powell, the Fed chair. He's brought in Stephen Moran, his Council of Economic Advisor head, to now also be a member of the Fed Board of Governors. And although it's a temporary basis, you never know. Maybe in 3 months' time, we'll be talking about Stephen Moran as the next chair of Fed. I don't think so, but everything is possible in this administration. But the fact of the matter is, people like Stephen Moran will try to influence the Fed's voice in a very big way by talking about how useful it is to have this tariff regime and how it's a one-off for inflation. The Fed should look past that. So contrary to what Powell and his Fed has been communicating, these guys will have a very different way of giving the Fed's perspective, and that could lead to a lot of acrimony, and the votes would be split in the Fed decision-making. All of that is coming for us. But the upshot, because we're discussing in the context of tariff and inflation, is that as the Fed's voice becomes a bit diluted with people with opposing views not necessarily giving ground, and then the chair, Powell, having to step in and impose his vision, I think it'll again start hurting the Fed's credibility and its credential as a fighter of inflation and also the dual mandate. People might think it is becoming very, very politicized. So that's the risk. I said earlier that today's presentation was about tariffs, stablecoins, and rates. So let's talk about the stablecoin part a little bit. A lot has been happening in the last couple of years. We touch upon this usually in the context of our digital asset update. We have a quarterly webinar. We also have monthly updates. But this time, I think that we've come to the time that we bring this discussion in the context of our Macro Insights Livestream because there's a lot going on. So the Genius Act that was passed last month is potentially a game changer because the US government is now basically getting very involved. It's not issuing its stablecoin by itself, but it is paving the ground for a regulated, fairly transparent, and fully supported ecosystem of stablecoins issued by private entities in the US. Now, this regulatory system that has come out, the US is sort of boasting that it is the first federally regulated system for stable coins. I think there are other countries who have also given pretty clear instructions of how they want stable coins to be regulated. But nonetheless, the US being the largest economy in the world and the printer of US dollar, it's a big deal that they are not giving their blessing. Now, some of the aspects around that give you the impression that it is going to be okay. It is going to be 100% reserve backing with liquid assets like US dollar or treasuries. So you can't really create phantom stable coins. In fact, think about it from a monetary distribution issue. One stable coin would entail basically a substitution of stable coin for treasuries, and treasuries you could argue is almost interchangeable with reserve interest-bearing reserves held with the Federal Reserve. So interest-bearing reserves, short-term treasury bills, and stable coins are sort of complementing each other to some extent, and they're interchangeable, and therefore it's not really monetary creation. If I today say that I'm going to create 100 stablecoins, I would need $100 to back it up. So that $100 then becomes a backing for the 100 stablecoins. It doesn't create additional liquidity. Now, it gets a little more complicated than that. If in the decentralized finance system, my stablecoin starts churning a lot, much more so than it would have in the USD fiat system, because the world of DeFi is seamless and borderless and just goes back and forth, certainly velocity would increase. And you could also take it one step further. If the demand for treasuries go up because everybody's issuing stablecoins and they're buying more treasuries, that'll bring long-term interest rates down to some extent, or short-term interest down to some extent, and that could impact money demand. So then you have money creation. So as you can see, at first cut, if you ask like ChatGPT or something, it'll tell you that there is no monetary impact. It's a substitution between treasuries and stablecoins don't even bear interest, at least according to US regulation. So no big deal. There's no monetary impact. But if you push it and push ChatGPT or Perplexity to think a little harder, or you talk to us, we'll give you the next nuanced point that if you extend the argument of the impact of interest rates and by extension impact of demand, then even stable coins at certain circumstances could be generating new money supply. We would like to see how the US Fed is thinking about this. I'm not expecting the US Treasury to come up with insights on this issue, but I really would like to see Powell's Fed, how they're thinking. If you scroll the internet, BIS has very, very thoughtful papers on stable coins, and they talk about the 3 big tests of stable coins sort of validity. They call it, I believe, one is sort of the single nature of money. Are all stable coins the same? Or the elasticity, that just like in the domestic fiat money supply, a central bank incredibly provide ample liquidity to the system for a price by modulating interest rate. Can you do the same thing with stable coins? And then the whole issue of integrity, meaning can you ensure regulation that are implemented and capital controls or any sort of other measures that you want to make sure that prevents fraud or theft to take place. Things that you can do when you're a central bank and you're issuing money, can you do the same thing with stable coins? So issue related to these things, singleness, the integrity, the elasticity are critical. These thoughts are coming from BIS. I'd like to see the Fed get a little more serious about it, given the context of the Genius Act. So now, mind you, it's not just the U.S. that is into this game right now, and already, like the Amazon, Walmart, J.P. Morgans are exploring issuance of USD stable coins. You travel to Hong Kong, you travel to Shanghai right now, you'll hear about startup after startup all getting in the game of RMB stable coin or Hong Kong dollar stable coin, and the regulatory authorities, the local entrepreneurial ecosystem, everything is beginning to churn in this part of the world as well. It's not just a US-centric, dollar-centric phenomenon. So lots to see here, but don't think this is an unmitigated good. There are things to worry about in the context of stablecoins. I want to finish my side of the presentation with these final thoughts. I've sort of touched on many of these already. Do stablecoins add to the US money supply? And I think, again, the short answer is no, but the longer, more nuanced answer is yes. Do they help avoid capital control measures? Absolutely. We're beginning to see signs of that already, that many developing countries with capital controls, we're beginning to see a big pickup in demand for stable coins, because through the blockchain, you can avoid your country's regulations substantially. Is this like good for the US dollar, or is it bad for the US dollar? Not quite sure, because we have some nervousness around US dollar. The likes of Stephen Moran, as they gain more and more power, seem to be very much in favor of a weak dollar. Trump doesn't seem to be that keen on a strong dollar either, neither is Scott Bessent. So there's a policy signal coming from the US that they would like to see competitiveness being complemented by a weak dollar. But at the same time, they're pushing out stablecoin. They want to be the world leader in stablecoin, and that would, again, on the margin, lead to a bigger demand for US dollar. So not entirely clear to me what happens. But the third question, do they impact monetary policy transmission? They do. They weaken monetary policy transmission. If you have fiat currency, you have a lot more control on the issuance, the earlier point that I made, the singleness. Every dollar that is printed by the US Treasury is a dollar accepted worldwide, no questions asked. Now, do we sort of trust the Amazon stablecoin versus some other company stablecoin? I think the answer is not quite. It won't be the same. Similarly with elasticity, the way the Fed can manage liquidity on the fiat system, not entirely sure they can do the same thing with stable coins. And I was actually mentioning this to Eugene right before we started this session. There are already studies showing that in the direction of interest rate, there is an inherent asymmetry with respect to stable coins. When people are comfortable with US Treasury outlook, they are comfortable about buying stable coins, they buy stable coin, fund flows into the Treasury market because people buy Treasuries to back it up. That leads to a rally in the US Treasury yield. But when people sell stable coin, empirical studies are suggesting that at that time the sell-off leads to a bigger risk or bigger pickup in yields. So there's an asymmetry. The rally is smaller than the sell-off. That again is a fairly problematic thing as far as monetary management and integrity of the fiat system is concerned. Lots of interesting questions. We'll keep coming back to you with these things. But for the time being, let me pause right there, bring back Eugene. Eugene, talk a little bit about the rates picture.
Thank you very much. So moving on to rates, right? But before we get there, so if anyone got any questions from whatever time has talked about stable coins, tariffs, please go to Pigeonhole. We will take all of the questions towards the end of this presentation.
dbs.pigeonhole.at, password macroAUG25.
All right, so I'll kick it off. Right, so we have gone through a lot this year, right? At the start of the year, a lot of anticipation over what Trump's going to bring, and then a lot of messiness through Liberation Day, the market shock, and then the even bigger market recovery. Right, so when we think about interest rates, so over here it's just 10-year local currency government yields, just picked out some of the main ones across the world. We can look at the performance, we can look at the themes, we can look at what people are worried about at different points in time. But if we take just this snapshot from early April to now, there are some takeaways, right? So within the G10 space, it is somewhat mixed, right? So we have gone through periods of worries about the budget, right? Bond vigilantes. We're worried about inflation. We're thinking about diversification, right? So within the G10 space, we're split very broadly into two camps. And the ones which saw interest rates rise, interestingly, it's JGBs as well as German bunds. So clearly over there, the inflation dynamics, the fiscal dynamics are a lot more worrisome. And it is actually pushing up interest rates in those areas despite the decline in 10-year US yields. Now, this part on the US part is also nuanced, right? So there are still lingering worries, fiscal worries about the US, but there are growth concerns that are for now overshadowing this kind of fiscal worries. So very, very nuanced kind of picture, very mixed within the G10. But if you look across in Asia, right, aside from CGBs, you see that 10-year local currency yields have fallen significantly. And the best performer is SGS. Now, there are two main reasons for this. One is that diversification flows are very, very strong, right? So if you look at policy uncertainties stemming from Trump's administration, people who are generally very long on US assets, whether it's equities or fixed income, now have an incentive to try and diversify out into other areas. And if you want safety, you might be looking at, say, Singapore. If you want higher yield, you might want to look at, say, Indonesia or India. But by and large, there are trillions of dollars that need to be moved. And trillions of dollars need to be moved over a period of several years because it's not easy to move that much money quickly. Right? So against this kind of backdrop, it makes sense that yes, Asia yields are falling and SGS is a clear outperformer. Now, the other angle is that if we think about tariffs, if it's applied, right, then we have US consumers, they might take a hit, they might buy less, right? Insofar as the rest of the world generally sells to the end user, which is the US, then the demand for Asia's products might be dampened, right, over the medium term. So under this kind of considerations, growth concerns will weigh, and then this will mean that in terms of policy settings, we should have lower policy rates, and in terms of where the curve should be and where the longer end yield should be, it should be reflecting some more of these kind of growth concerns. And again, these two reasons are why Asia government bonds have generally been doing very well. China is the exception because China has been facing very challenging GDP growth outlook, growth challenges, property market stresses over the past few years. And yields are already at very, very low levels. And I think the play over there is whether there could be some sense of stabilization. But with yields already below 2%, closer to 1.5, 1.7, there might not be that much room for a very, very sharp rally that we have seen in the rest of Asia. Now, another way to analyze rates movement would be the very front of the curve, right? Anything out from 1 year, 2 year to 3 year segment. So again, we can split the DM space into roughly 3 groups, right? And the most interesting aspect for me is that the Fed is now priced to be the most dovish within the G10, right? So about 5 cuts, 125 basis points by the end of next year, at a point where sentiment is very, very strong. And we would argue that data-wise, it is not that clear that we are heading into a big recession, right? So that is one extreme. Now, the other extreme, as mentioned, is Japan. Japan is behind the curve. There's some political uncertainty over there that may hold the BOJ back from hiking that fast. But the trouble is that the BOJ is already behind the curve. And then the slower it hikes, it might mean that there will be more upward pressure on the long end. So the period of slow, controlled hikes is the most likely scenario. Now, there are a few others like BOE, Norges Bank, RBA, which have a little bit more to go because they've been lagging in terms of the cut cycle. So they could cut a little bit more. And the rest are about done. So for example, for ECB, Lagarde was a bit more hawkish, having delivered 200 basis points of cuts. Is there really a need to do more? Are there signs of financial stress? I think the answer is no. And then what if we think about the S&B, right? Rates are already close to zero. Again, do we really want to go into negative rates, right? In any case, there's not much room to cut rates further. Right, so very different divergent paths in the front, which is reflecting the same kind of divergence that we see for the 10-year segment as well. Now, in terms of sequencing, we think that the focus for investors are changing, right? Anticipation of Trump's policies, the hard hit on Liberation Day, and over the past few months where things get organized, right? The way we see tariffs is that it is becoming clearer, right? There are still a lot of uncertainties in terms of sectors. There's still the overhang on whether there will be a deal with China. But by and large, tariffs are no longer having that much of an impact onto the market. The other part that is interesting is that the One Big Beautiful Bill, which is one of Trump's key promises, has also been delivered. The debt ceiling has also been lifted. So that too has been organized. So with the bulk of these things put aside, it feels like the market is now a lot more sensitive to data or the real economy. So data matters once again. So when it comes to data, right, for the US, if you look at the dual mandate, you need to make sure that people have enough jobs and to make sure that prices are stable. So 2 weeks ago, we got the shocker NFP, right? So with the downward revision in non-farm payrolls, the monthly average for the past 3 months fell to 35K. Right, 35K viewed in the context that over the past 2 years, the average was closer to 150K, then it is a very, very sharp markdown. But does it really mean that the labor market is cratering? We do not think so. I think that at this point, given the volatility and revisions in payrolls, each monthly point of data provides more noise than signal. Right? In fact, if we look across the broad range of labor market data, it is only NFP, which was very, very strong prior to the downward revisions. So I would say that NFP is now converging together with the broader set of data that is showing that yes, the labor market is somewhat weakening. And the other puzzle that many of us have been thinking about is that how can you have such a huge market impact on Liberation Day and have no impact on hiring that shows up on NFP? But with the revision, that has changed, right? The data shows that for May and June, the companies are a lot less comfortable with hiring, right? Which gels with the broader set of data that we've been looking at, right? And then the bounce in July's data is the issue that I think some of the market participants may have missed, is that are we at the point where certainty, there's more certainty from Trump's policies, and therefore this hiring has resumed, right? So I think there's a multifaceted view towards the labor market, and it is really a lot more nuanced than what the headlines are suggesting. And if you look at how the yield space is adjusting, we note that front-end yields had a one-off adjustment, and then it sort of stabilized, right? So I think the jury is still out, right? Is it just a transitory slowdown, or is it something bigger? Now, against this kind of backdrop, I already note that in level terms, there's a one-off adjustment. But what about the curve, right? The curve has been steepening for the past 2 years or so, right? It makes sense, right? You have fiscal worries, you have some Fed cuts being delivered, and if you look at where we are now, sentiment is very, very buoyant, right? So are we looking at a recession, right? Something that people have talked about for a while. You're going to have a recession, then the 2 year, 10 years will have to steepen a lot more, because people will argue 4 or 5 cuts will not be sufficient. But how confident are you making the call that recession is the base case, right? And if people are not that confident, then perhaps 530s, right? A recession is somewhere further out the horizon, and yes, the fiscal issues are not done yet. So 530s are a better bet, and you notice that yes, the steepening pressures are a bit more acute, whereas for the 210s, it's sort of range bound, and we are towards the upper part of the recent range. Now, what about recovery? Again, something that most people would not entertain, but it is again well within the realms of possibility, right? We have very aggressive fiscal spending in the US, and we have a very buoyant stock market. So yes, we have an overhang, some kind of payback from export, import front loading, but next year things could be better. And then there's also the Fed view where we go into stagflation light. Now, if we go stagflation light, we might have flatter curves because the Fed would have a conflict in its objectives. And then if that's the case, then the safer place to hide might be the long-end yields. Right, so it's just not so clear from a curve perspective in the short term how things are going to play out, because all of these scenarios look fairly plausible. Now, if you want to talk about liquidity, and that's where I try to bring in the stablecoin considerations that Time was talking about, right? So in terms of liquidity, our estimate is that for the US financial systems, we have about 1.5 trillion of excess liquidity in the system. It's been fairly stable for about 6-7 months, where yes, QT has been ongoing, but at the current pace, it is practically stalled. Right? It's a very, very slow pace of QT. And the other thing to think about is that there's been a large TGA drawdown when there was the debt sitting in place. So the TGA build-up will start to draw down liquidity from the Fed's repo facility, excess reserves. And after the drawdown, we think that excess liquidity would probably be closer to the 1 trillion area, which I think the Fed would be fairly happy about. There are some signs of tightness, right? If you look at SOFR versus, say, the effective Fed funds rate, that rate has been a bit more volatile. And yeah, so there are some signs of tightness. So I think policymakers are definitely keeping an eye to make sure that the repeat of the very tight liquidity that we saw pre-pandemic and the repo crisis will not take place again. Now, the part about stable coins would be to understand what the actual use of stablecoins would be, right? So I think from the first order perspective is that stablecoins should be used for transactional purposes, right? It's not supposed to provide interest. So in that case, then that should lead to a substitution, right? From the very basic first order. So instead of having dollars in the current account, you would be holding stablecoins in your wallet, and you will be using stablecoins for transactions instead of US dollar. Right, so from a pure transaction perspective, no other speculative elements or other kinds of illicit flows, then there should not be that much of a difference, right? Again, it's just substitution. Now, stablecoins are backed fully by dollar assets, and most likely it will be just T-bills, so very, very short-term T-bills. So on a net basis, there will be an increase in demand, right? So if that is the case, then T-bills will likely trade rich, meaning that T-bill rates will be lower relative to the other kind of instruments which don't get to see this kind of demand. However, the deviation from each other there will be limits because you are ultimately still bound by where the Fed funds rate is, and that is still the guiding principle. So yes, T-bills could go richer by 6-7 basis points if we get, say, 2 trillion of flows into T-bills, but ultimately you cannot deviate too far from where the Fed wants the rates to be, right? And then the other thing to note is that in terms of monetary policy transmission, that could be a source of concern for policymakers as well. But I think it is not just the Fed across Asia, whether all of the policymakers who are looking to have stablecoins in their system will have to consider that there is this loss of control and how to manage this, right? And then the last part would be insofar as if dollar stablecoins take off, does it mean that there will be increased confidence that the dollar hegemony in this transactional aspect will maintain? Would there be an increased confidence that is a second order, third order impact that could impact the markets, right? So these things are all largely theoretical. We will know in time, but this issue is multifaceted and will have impact on the traditional asset classes as well. Now, we're done with the global view on back end, front end. We've talked a little bit about the dollar curves. So I'm going to zoom into Singapore, right? ESGS, right? The best performing 10-year yield within the 10-year Gavi that we track, right? So the reasons for investing in SGS has been very compelling, right? You want AAA, you want a well-run government, and then with no fiscal concerns, right? And then in terms of the size of the market, Singapore is much, much smaller compared to, say, US, Japan, Europe. So when the money flows come in, it has pushed local currency yields to very, very depressed levels. So spreads to the US have really widened significantly. We just want to look at it from another angle. Now, what if we look at things from a dollar investor perspective, right? Who don't want to have the Sing dollar FX risk, right? So typically what they would do is that they will have some dollars and then do a cross-currency basis swaps. And then along the way, they will pick up exposure to SGS. And as they do that, there will be some gains or some losses in terms of pickup. Will you be gaining more, higher yield compared to US treasuries, or will you be receiving less than what you would get if you just simply bought treasuries? Right, so at the chart over there, we have the 5-year and the 10-year. And what you notice is that after Liberation Day and then closer to May, June, July, this demand for people willing to do this kind of trades have picked up so much such that if a dollar investor wants to run this trade, they will be running a negative pickup, right? So they'll probably be better off just buying treasuries on its own. No point doing the swap. Now, you flip it to the other way. What this means is that for Sing-based investors, it is now more interesting for them to hedge out their FX exposure while buying some dollar assets, right? So the script has flipped. And it's also interesting for some of the corporates who wish to issue in Sing dollars, take advantage of very low rates, flush liquidity, and so far insufficient papers, and swap some of the proceeds into US dollar for their own investing needs in other parts of the world, right? So things are shifting. The narrative is shifting as the levels adjust. Now, if we move on to other parts of Asia, like bucketed into two, right? So one of the ways when we think about Asia local currency bonds is that there is always this FX risk element that needs to be quantified, right? So a typical way, the traditional way where a lot of managers could be looking at it would be the amount of yield that you're getting adjusted by interest rate volatility. But I'm thinking that if FX volatility is even more important now, then perhaps it should be the yield that you're getting adjusted by FX volatility to account for that kind of risk. So the chart on the left we have SGS and CGBs. Right, so by and large, they've been broadly tracking together pretty closely over the past 2-3 years. Right, so, but more recently, they have diverged. So this is another way of saying that SGS, after having outperformed so much, right, on the FX forward adjusted basis, it is no longer as compelling. Whereas if you look at CGBs, right, and we look at 10-year CGBs in one of the earliest charts which I showed, 10-year CGBs actually went up. Now, if you adjust it for this FX risk, then it is now a lot more attractive compared to where CGBs were, say, a few months ago towards the start of the year. Right, so if we apply the same logic to the higher yielders, India government bonds, as well as the Indo-GBs, they kind of make sense as well. There was a period over the last 2-3 years when IGBs looked very, very attractive compared to Indo-GBs, right? But this gap in attractiveness has since narrowed, and now they are trading very, very close together, with India having a slight edge. But I think for this kind of high yield govies, the key factor really lies with the US dollar. Right? So far, even after the CPI data that comes out, investors are heavily betting that a more dovish Fed, with perhaps a more dovish mix of members, will engineer the rate cuts that would be a further boost to sentiment. So in which case the US dollar can stay weak, and this will allow investors to have considerations that the central banks can cut rates, and yes, perhaps we should go for more carry, and this will be probably supportive of this high-yielding Asia government bonds in general. So I think so far things are okay, but if the dollar starts to strengthen, all right, against the odds, then it's time to revisit the view. Now, this will be my last slide. So the fair amount of things to take away, right? So in terms of yields, many different themes over the past 8 months or so. But if you look across the G10, it is really very mixed, right? Now, the Fed is priced to be the most dovish. And on the other spectrum, we have Japan and German yields that are pushing higher. So I also mentioned that UK yields recently have also started climbing up again. Now, that is the case for the G10. But if you look at Asia, by and large, yields have drifted significantly lower. And there are two key reasons for it. One is from an economic perspective, growth slowdown fears are more acute under the high tariffs environment. Right? If that is the case, then it makes sense to reflect lower policy rates. It makes sense to reflect a weaker growth outlook, all of which means that yield should be lower. Now, the second part is diversification. So insofar as this is likely to be a structural theme that takes place over 5 years or so, then there will be this kind of demand for Asia assets that will keep coming in, right, to support. So in which case, then Asia's yield should be low, and Asia's yield premium over the US could likely compress even further. Right, then the next part on the US, I think there is no clear picture. We have tried different narratives at different points, right? Whether it is stagflation light, recession, or actually things are okay, Goldilocks, right? So in terms of levels, in terms of the data, interpreting them is a lot more nuanced. It is not so clear cut, right? So I think it is probably better to wait for a couple more months of labor market data to see whether the NFP shock does it extend, or is this actually a more stable kind of steady state that we're looking at going forward, where immigration is a lot more constrained, and then the demographics is aging, right? And then the next point I want to talk about, SGS, very strong outperformer over the past few months. But at these levels, it does look a little bit stretched. Looking at the spread versus the US, looking at the after swap kind of pickup has turned negative. So I think considerations over sync rates have adjusted, right? So we just have to be aware that flows could shift the other way. And then the last part, when we talk about the higher yielders, like Indo-GBs as well as India government bonds, FX is very, very important, right? In terms of vol-adjusted carry using FX, right? It is no longer as attractive, but insofar as the dollar is likely to remain range-bound or weak, we think that this additional demand for Asia assets will be supportive. But if the dollar starts to creep up over the next 2-3 months against a lot of people's expectations, then we would have to revisit these ideas. So I'll just stop here.
Great stuff. Eugene, a quick follow-up question. We have lots of questions to go through, but I just want to ask you this. Home bias. A few months ago, we felt that the cross-currency basis was switching in terms of European investors deploying some capital to Europe, the Japanese and Japan, and the CGB, the rally that has happened, that it will be interested in China too. So what's your sense of that?
Yeah, I think the home bias will still be there. It's just that for many of these investors, say whether we are based in Singapore or Europe, we still hold a lot of dollar assets, right? It is this shift away from dollar assets into somewhere else. And because this amount is so large and many of us are so heavily long US assets that this shift will take time, right? So I think it is really, as you have mentioned in one of the pieces, is the incremental change that is the part that's important. It's not the active selling of dollar assets that is important.
So it doesn't have to be de-dollarization. It could be remain invested in the US, but also some of your allocations incrementally start going to non-US destination. Okay, very hard question for you. Let's go to the screen. And gotta read this carefully. Do you see the fall in SORA as first derivative impact from de-dollarization?
I think that it is one of the main reasons, and yes, it has a direct impact, right? Insofar as from a pure flows perspective, if people are looking for very safe assets, there are not that many in the world, right? If you want very safe assets, AAA, no fiscal problems, and then politically very stable, you can count with two hands, right? And the Sing market is very, very tiny. So yes, insofar as we are a small market and there are a lot of flows, and as the money gets converted into Sing to buy Sing assets, yes, it does push down our interest rates.
Does it make MS's life difficult, or MS is happy to take the easing?
I think in some ways it is a happy problem to have, because I think outflows is generally a lot more difficult for central banks to manage, right? You have to keep interest rates high, squeeze liquidity, and try and stabilize. Inflows is a happier problem. It's more of a matter of managing it, right? If interest rates become too low in Singapore, would there be some unintended consequences?
Asset price bubble, for example.
Yeah. So these are okay, but I think can be managed through macroprudential measures.
Right. So, I mean, we've seen some measures in dealing with foreigners' ability to speculate on Singapore properties, but I wonder whether the next round of measures that will come would be aimed at domestic investors.
The property prices keep going up.
That's right. Absolutely. Yes. We should do a whole thing on Singapore property one of these days. Let me take on a few other questions. So Eugene, let's take this together. How would your expectation of 2 Fed rate cuts impact the US dollar outlook for the rest of the year? So I think that our colleague, senior FX strategist Philip Wee, has been pretty vocal about this issue, that he doesn't see a big leg up in the dollar. Weakness to sort of persist for the time being, but not a big US sell-off either. The 2 rate cuts that we're talking about would probably not match, but certainly responded to by other central banks as well. Another 25 bips of rate cuts in various parts in Southeast Asia, and South Asia is definitely on the cards for the remainder of the year. So I don't think the US dollar outlook would be materially affected by these 2 cuts that the market is pricing in.
Yeah, I don't think so. I think the issue here is that whether these cuts are anticipated. Right, so if you look at the rate space, right, it's already pricing in about 2.4 cuts. It's already beyond what we're doing. So in order to have further dollar weakness just purely from this interest rates expectations, you need to price in 3 or 4 cuts by the end of the year to materially impact the dollar. Yeah.
So for me, if Stephen Moran's name starts getting associated with Fed chair, we can see some serious dollar weakness. If we see more U.S. measures against countries that want to sort of de-dollarize or something like that, they may think that is helping the dollar. I think that would actually undermine confidence in dollars. So stuff like that, I think, is a far bigger risk right now than the risk of the rate cuts fueling some sort of sell-off in the U.S. dollar. Yeah, I agree with you. I'm there with you. All right. Trump is about to meet with Putin in Alaska. So the question is, the U.S.-Russia tensions would subside. Any impact on oil prices? Okay. With or without a U.S.-Russia deal, my view on oil is that it is very well supplied and the demand side is subdued. So you may try to calibrate all sorts of geopolitical risk premium around India stopping to buy oil from Russia and then buying more from Dubai or Middle East or maybe the US, the gas side of the story as opposed to oil. I don't think that really matters. The fact of the matter is, globally, led by China, fossil fuel-related energy demand has more or less peaked. And especially because China is so large and its industrial capacity is so big, the fact that their oil demand on the margin is very, very weak is sufficient to have a chilling impact on the demand for oil and other energy products around the world. You combine that with the fact that between the US and Latin American countries and Central American countries and the Middle East and Russia, there is ample oil supply. I really don't think the U.S.-Russia issue will have a material impact on oil prices. Now, I think the last couple of weeks, both Radhika Rao, our senior economist who covers India, and I have faced many questions from Indian journalists on this issue. Will we see India pivot away from Russia and buy more oil from somewhere else? Maybe. But does that necessarily mean that it fundamentally alters the global market of supply and demand of oil? No. So I wouldn't really worry about that. Oil is on the back foot. 60, 65, that's the way we're going to see. Maybe it doesn't have any further room to crash, not to the 55, 50 range, but I don't see it going towards $70, $80 absent a major conflagration somewhere else either. We have a couple more minutes left. Let's take, good question. I wish Will Young was here. Any thoughts on the crypto rally? Inevitable, right? The sort of support the crypto space is getting from the US president, whose Trump empire itself is very much long the crypto space, and top of that, all this Genius Act and stablecoin related support. The US has gone from being fairly skeptical about the DeFi world and the digital currency world to like the biggest cheerleader. And because the US is so large, and now that they're sort of putting their weight behind the dollar related stablecoin, the rest of the world is scampering to catch up, clarify regulation, trying to make sure that they don't get disintermediated, they don't feel that they're losing control of their capital control measures, and that they are not being left behind on the race to embrace the new kind of finance. So all of those things are fueling into this feel-good factor. Cryptos have only one way to go, up and up. And same with stable coins, lots more interest and lots more issuances. The associated complications. Are all stable coins the same? Should we think the proliferation of stable coins in some way undermine the cryptos? Because if you think about stable coin as a gateway to the digital world, both on-ramp and off-ramp, then all of a sudden the use case of crypto actually diminishes in my view. I don't think they complement each other. But right now, everything is facing the moment in the sun. It's going up. And as Eugene said, the market is expecting lower rates in the US. That again is on the margin positive for cryptos. I suppose we have time for one final question. Let's take, I'm going to take a question that I'm actually not very comfortable answering because I don't know much about this issue, but I'm going to take it on anyway. Is it true that Canada has returned close to $3 billion worth of dairy products to the US, including milk and cheese? What is causing price inflation to basic food products? Okay, second part first. There is very little food inflation in the US right now. I just looked at the July inflation print. I think beef steak prices, Eugene, went up a little bit, but egg, which was a very big source of inflation, and it's actually on a year-on-year basis still a double-digit contributor to CPI, it's actually declined quite a bit in the month of July, and overall food inflation's contribution on a month-on-month basis is negligible. So I don't think the spat that is happening between Canada and the US is material for US food inflation. Now, US is accusing Canada of putting up a whole bunch of protection protectionist measures against U.S. dairy and U.S. agricultural products. And that's a big bone of contention between the two countries. And I think even under the USMCA, that part might be subject to additional tariff, if not the 35% that the U.S. is threatening. U.S. is pushing the agriculture sector around the world. India is also facing a lot of pressure from the U.S. on opening up its agriculture sector to U.S. products. I think that this is, again, going back to the very first point I made, that the tariffs are being broadened. Now they're also being used for domestic sector support and getting market access elsewhere. I don't think the Canadians will blink so much. By the way, the Canadian Prime Minister actually does not have too much authority on some of these tariff measures. The Canadian Congress, the Parliament, has tied their precedent's hand far more than the U.S. Congress has Donald Trump's role. So the U.S. has to sort of appreciate there's only so much one-on-one negotiation between Trump and Carney can yield on this area. So that question remains open. Canada-U.S. friction is not going anywhere. They can live without each other, but they're also not very happy with each other. On that note, we're going to conclude the live stream. Eugene, thanks very much.
Thank you very much.
Very interesting times. We're loving covering these areas and bringing the new insights to you. We'll come back again next month with more of the Macro Insights live stream. Until then, everybody, stay safe, stay healthy. Bye-bye.